Bank of America, and one of its claims to fame, Seema, is that they have a banking relationship, reportedly, with about half of Americans in some way, shape, or form, whether that's traditional banking or mortgage lending or credit cards or whatnot. They seem to have a good pulse on the U.S. economy and the consumer side of things. Do you believe the consumer is as healthy as Brian Moynihan would claim?
Hi, I think clearly the U.S. consumer has been very resilient to this point, and they have been helped by this huge amount of exit savings that has been built up over the last 2 years. I think the question is how long that can stay. We are starting to see cracks forming. You do hear even from Bank of America, a lot of their credit card data is starting to show signs of weakness. You see that corroborated across a large amount of data out there. So we do think that the consumer is strong right now, but if you fast forward 6 months to a year's time, certainly the consumer will be feeling additional weakness. And of course, remember that the stronger the consumer is today, the further the Federal Reserve has to hike rates. So that will increase chances for recession later on.
So, Seema, we've made a good deal of, I guess, importance out of this conversation we're having about whether the economic data that may be backward-looking, the things that we can count, like jobs, GDP, that sort of thing, seems to be going okay, but some of the forward-looking stuff, like sentiment and poll surveys, doesn't seem to be backing that up. Would you consider perhaps right now some of these anecdotes coming out, the reports about companies slowing hiring and perhaps even rescinding some job offers, as a sign that we will see perhaps a more material weakness in the labor market in the weeks and months ahead?
Yes, absolutely. A lot of these indicators that we look at are leading indicators. They're not going to be showing signs of, they won't be showing weakness right now, but they are showing that there will be signs of further cooling in the economy as we go through the next months and next couple of quarters. And then certainly we are expecting recession to hit the U.S. economy in the first half of next year. So, we are, of course, reassured by the strength currently, but that doesn't mean that the U.S. is going to avoid recession next year.
So if that's the case, then, if you look at the way that the Fed is set up for how it has to act, is there any constructive way that the markets can take these future interest rate hikes in stride enough to form some kind of a move higher here for the broader markets? The question I often get is, when is the bottom going to happen? Nobody really knows, but is this a situation where the Fed is going to derail everything, or can they engineer that unicorn of a soft landing?
I think, look, it's not impossible, but it is certainly very unlikely. As you said, historically, there is very, very limited evidence of the U.S. being able to manufacture that soft landing that they keep talking about. Certainly what we are expecting is that the U.S. almost has no choice. They have a significant inflation problem. The only way to rectify that inflation problem is, unfortunately, to create a significant economic downturn. So this is something that the Federal Reserve has to do. And if the most likely scenario at this point is, unfortunately, a hard landing.
So if it's the hard landing, then what is the outlook in your mind for where people should be positioning? How exactly is it? Right back into Treasuries? Because it seems as though you don't want to be there if interest rates are going higher at some point and inflation's a problem. Or is it in some of those more beaten up sectors, or do you stay with the kind of trend that you've seen with some of these value oriented, dividend type paying, more economically less sensitive type sectors out there?
Yeah, look, it's a really, really tough call at the moment to know where to allocate money. Within U.S. Treasuries, yes, there is certainly an element of safety, but as you pointed out, rates are going to be going higher over the next couple of months. But given that we do see recession in the horizon, we actually see U.S. Treasury yields going lower over the next 6 months to 1 year. So that is a place to hide out. In addition, quality. So this is talking about your high-quality investment grade companies, which can possibly perform okay during this downturn. Certainly, we would stay away from some of those high-yielding companies. And in addition to all of this, it's really talking about high quality, talking about companies which have got that stability of earnings, and also in addition to that, pricing capacity to keep pushing through price increases to consumers. So this is inevitably, it's a difficult environment, but there will be places to hide out right now.